Welcome to the Educated Homebuyer podcast. We have a special guest for you today, a true heavyweight in the industry, Tony Hutchinson, the Executive Vice President at VantageScore. Tony's been in the middle of housing policy for nearly 3 decades, shaping everything from Dodd-Frank to the qualified mortgage rules. He's held major roles at Freddie Mac, Fannie Mae, and the National Association of Realtors. So when it comes to how credit and policy impact homeownership, you're hearing it straight from one of the top voices in the country. He's going to break down what it means now that Fannie and Freddie are set to accept VantageScore and how that shift is going to directly benefit you as a home buyer. Enjoy the show.
If you've been told your credit score is too low to buy a home, or you're just stuck renting because your file is too thin, that actually might change this year. A major shift is happening in the mortgage world that could help millions of more Americans finally qualify to buy a home, and most people don't even know about it.
So, Tony, this is a big topic right now. We actually did an episode about a month ago and then connected with you guys to get it straight from the horse's mouth. Why don't we just start with why is VantageScore a big topic in relation to mortgages right now? What happened? What's the change? And why is everyone talking about this right now?
Yeah, and first of all, thank you guys for having me. It's great to be here. And, VantageScore is out there doing its best to get more information about the company, and this change to the marketplace. So the work that you're doing here is absolutely appreciated. Thank you so much. The big occurrence is that beginning as soon as Fannie Mae and Freddie Mac indicate that they can digest a VantageScore, the conventional conforming market, so that's the mortgage market that accepts Fannie Mae and Freddie Mac accept mortgages in, will be able to accept any mortgage out there that meets their criteria. And along with that, you'll be able to utilize a VantageScore. As you guys know, and everybody in the marketplace, in the past, there's only been one score that's been used, and that's the classic FICO score in the marketplace. That score has been around since the late 80s, early 90s. So, the consumer population has changed. And one of the things that everybody wants to do is make sure that Fannie Mae and Freddie Mac have the best technology out there so that they can operate extremely safely and extremely soundly, specifically coming out of the Great Recession. They want to make sure that they have all of the potential guardrails in place. And one of the places that Senators Tim Scott and Mark Warner thought needed to be addressed was credit scoring. Effectively, they wanted to see more competition in this space, and they wanted to see more competition so that there is the possibility that newer scores based on current consumer activity would be able to be utilized in the conventional conforming space. So again, Fannie Mae and Freddie Mac would be able to operate safe and soundly. So circa 2018, you had a piece of legislation that had as part of it the Credit Score Competition Act enclosed. It was signed into law. That was under the first Trump administration. Fast forward to the Biden administration, they began to take that rule, that law, and implement it. And they moved the ball about 80 yards down the field, if you want, gathering information from the industry, from the GSEs, and actually doing the evaluation to see what scores out there made sense to utilize in this new regime. October 2022, they say, hey, we've found 2 new scores, one of which being VantageScore 4.0, to utilize in this new space. Circa July of 2025, the FHFA director, Bill Pulte, says, hey, we've been looking at this long enough. Let's go ahead and implement it. So now you've got the GSEs, Fannie Mae and Freddie Mac, on a fast track to get us into the market so the consumers out there can utilize us. The benefit to them is, and it's a couple of things. One, we use trended data in the new models, which means we no longer look at you at a point in time. So we're not looking at you saying, what are you doing today and what has your credit looked like up to this point, and today, how is it reflected? We take a look at you over a 24-month period to see how you've performed, and then we evaluate you for credit. So we're taking a lot of time to see. So you could have been great and trended down. That's going to be important for financial institutions to know. You could have been down and trended up, and that's great for you. Or you could be just stagnant and really be good at making your payments and maintaining your credit utilization at a moderate rate, and you're going to have a good score there. So it really allows us to dive real deep into the credit score and really see some good trends.
As a mortgage professional and someone that works with people and credit, I really want to dive on that. So I want to
Yeah.
go a little bit deeper on the benefits and maybe some downside to that and kind of hear your feeling. But one thing I really want to talk about and make sure that everyone's aware, this is not a partisan issue. You said this came up. We live in a hyper partisan world and people want to
We
blame, oh,
do.
this one side wants this, one side wants that. Came about during the first Trump administration, like you said, was advanced heavily during the Biden administration, and now they're trying to get it across the finish line. The timing of this really comes down to more of just how difficult it is to get anything through the government. Fannie and Freddie are government-sponsored enterprises, so heavy hand of the government involved currently, in conservatorship. So when we try and make changes, it just takes a long time. And this is something that's very important. And it is almost 20 years ago now, 18 years ago, we had a terrible mortgage crisis. Some of that was led by government, bipartisan Republicans and Democrats saying homeownership is good. Let's expand homeownership. We can do that by going down the credit scale. And we were making loans through Fannie and Freddie to less creditworthy borrowers. So everything that we want to do here is to the benefit of homebuyers and consumers, and to make sure we're not putting the system at risk while helping more people become successful homeowners. So back to that thought there of the trended data. When I hear trended data, with FICO, what was it, probably 10 years ago, they said, hey, we're going to be looking at trended data. Now you got to pull your reports and it shows. So as a mortgage professional, I deal with a lot of people. Hey, I went through some stuff. Like I had 6 months, my wife left, lost my job, my dog ran away, and everything went bad and I didn't get my bills paid. And we can work with them to a degree and get some of these things cleared up. And in a really short period of time, depending on if you're able to get deletions, that pay for deletion, get things cleared off of that credit report, you can have a massive difference in the score and no one knows any different. So when you talk about trended data with VantageScore, is that still possible to make those rapid changes and improvements over 3 to 6 months? Or with that 24-month look back, it may be better for underwriting decisions to have that 24-month look back. Is it worse for consumers?
I don't think it's worse for consumers. I think it's actually better. And we'll get into this a little bit more when we start talking about some of the folks with thinner files and some of the information also that we evaluate in terms of generating that credit score. But having that well, first of all, I'll answer the first portion of the question. If there are things that need to be corrected, continue to do the same work that you've been doing, because you want to get errors off of your credit report. Removing errors and having the most accurate information is going to provide the most accurate score. So that work needs to continue to be done. In terms of, knowing that you went through something and trying to find ways to kind of get around that, you no longer really have to do that. Because if, say, 6 months ago you did have an issue, we can see what happened prior to that and then see what has happened since then. How have you been trending? How have you been correcting for whatever that issue was? And all of that is taken into consideration. So I think the longer window actually provides a better look into the consumer. And consumers really need to start thinking about that. This is not something that you're going to want to cure over, a 6 to 8, 9 week period. You can actually really take a little bit longer of a time and begin to cure it almost immediately. And we'll see that. You don't have to worry about, they aren't going to see the fact that, I had a mishap. I missed a couple of payments and now I've been good for the last 3 months. No, we're going to see that. And that plays to your benefit.
So now one of the things I've heard about VantageScore is that if you have thin credit, don't have a lot of credit, it's one way to produce credit scores, maybe not immediately, but a lot faster than you can with the FICO model. So we've talked about the FICO model being less of the trending data, kind of more of an old school method, and VantageScore using, what basically the trending stuff. So let's talk about maybe the differences in FICO just a little bit here, in how it can help somebody that doesn't have the credit profile that's been built over a 20-year period. Somebody maybe that's just starting credit. Maybe they're a Dave Ramsey fan and they don't have credit at all because he says, well, you shouldn't
that's
have
right,
one.
right? Yeah. That's right. So, first of all, I don't know the ins and outs of the FICO model, so I'm not going to really be able to get into that. But what I'll tell you is the classic score, like I said, is point in time. So that's number one. We use trended data, their point in time. That's a big difference. Utilizing that trended data along with the fact that we use machine learning And we dig really deep into the credit reports at each of the repositories, TransUnion, Experian, and Equifax. We're really able to get into those attributes that tell us how a consumer is going to perform. Included in those additional attributes that we look at are rent payments when they're there. So we're eager to have more rental payment history in the file because that's a great predictor of whether or not someone can afford a home or not. And it's so much of a good predictor. You see Fannie Mae and Freddie Mac trying to get more of that on the back end of their evaluation so that they can use it the same way we would like to get it into the credit score. We
How are
also,
you able to get their rental? Where's
so
the data coming from?
that
Unlike a credit card that
information,
gets reported.
yeah, that information is currently for not a large group, but for a group of consumers being reported by their rental payment organizations. So one of the things that Fannie Mae and Freddie Mac are trying to do is get more rental payment organizations to put their rental payments into the credit reports. We're supportive of that. We're also supportive of other enterprises out there like Isuzu and some of these other private companies that are trying to empower consumers to push their rental payments toward the credit reporting companies. Because again, when we have that, it can be a very it's very beneficial toward the algorithm. So if you're not paying, right, it's going to be a negative. But if you are paying on time, it could be a great positive. So you want to have that information in there. We also get information on telecommunication payments and utility payments. And part of the reason for that is, there's a big push, like you're doing this podcast and we're streaming services and telecommunications are a big part of everybody's life. So we want to include that information and how people pay on that because it's important in the algorithm that we utilize. So, between the machine learning, the trended data, the really mining for attributes like rental payments and telecommunications payments and utilities payments, those are the differentiating factors between us and the classic score that's in the marketplace, specifically the mortgage marketplace that most people utilize. We think that brings an advantage to the market. For safety and soundness of the GSEs, for better financial predictiveness for the financial institutions, but for the consumers, it really takes a look at who they are and what they've been doing, and it brings everything into account. Whereas in the past, you didn't have that. So if you didn't have a auto loan or a number of credit cards open or a previous mortgage, you were getting a negative associated with your habits. And to your point, if you didn't have any credit, or you had credit and then you decided to go dormant because you didn't want to incur any more credit. Well, folks who don't have credit or go dormant get a negative hit to their score using the classic score that's out there, using trended data because we've seen what you've done, because we see other trade lines outside of just credit activity. Now we're able to make a very good judgment about your ability to handle debt, and that plays to the consumer's benefit.
We have a focus here, the Educated Homebuyer podcast, people that haven't been through the process. They're the ones that want to educate themselves. So it skews younger, skews first-time buyer. So within the context of that, we have a lot of people from underserved communities, recent immigrants, people who are younger, even though first-time homebuyers are up in their mid-30s now on average, but you still get these younger folks. And in addition to the fact that you already hit on a little bit, younger folks use credit a little bit differently than us older generations. So I want to talk about a couple of things there. How do younger people who are less likely to be unscored or less scored, or just from communities, certain immigrant communities, they don't bank, they don't use credit, they pay cash, mattress money, things that are very common culturally in different communities. How can VantageScore benefit those groups and help them take part in the mortgage system?
Well, first of all, we score more people, and that's number one. So those communities that to this point have not had that traditional score in the marketplace, if you're paying your utility payments, if you're paying your telecom payments, in some instances out there, if we're capturing your rent, there's some other payments that are outside of just normal credit usage that are reported to the credit reporting companies, then we've got access to that. We're scoring you. So we score about 33 million more consumers with VantageScore 4.0, which is the one that's been set up for the conventional conforming space, and the classic score in the marketplace. Those 33 million more people run the gamut of the populace of the United States. So yes, it's in underserved communities. It's minorities. It's in rural markets. It's veterans, if you can imagine that. It's active duty service members who have been deployed and haven't had, you know, any credit activity for 6 or 8 months because they're out of the country and they come back. So we're able to see that. So and when you take a look at the geographic dispersion of all these newly scored consumers by VantageScore, it's in every state. It's in almost every county. It's almost in every congressional district. It's just throughout the whole United States. And if you guys want to see that, you can go to VantageScore.com. We have a free digital tool called Inclusion 360, where you can go and see how many newly scored consumers does VantageScore reach in your area. Hit the county, hit the state, take a look at your congressional district. You'll see that. And then if you just take a look at the whole United States, you'll see that, you know, we score all these folks. So we're getting out there. That's part of the reason that FHFA wanted to move to this trended data and wanted to include an organization like VantageScore, because, you know, the rules that we put in place for coming up with these algorithms, and I'll tell you this, you know, we're not losing any level of predictiveness, and we're not taking in more risk because we're looking at a large amount of data on the consumer, and the method for evaluating that, the use of machine learning has really helped us understand these patterns. And over time, and you don't have to just take my word for it. You can talk to anybody who's utilized VantageScore 4.0 since 2017 in the credit card space, the auto loan space, the personal loan space, the non-conventional conforming mortgage space. They've seen the value of the score, how it has opened the door for some folks and been very predictive. On the other side of that, for investors, on the asset-backed security side, you've got organizations like Synchrony, Toyota Motor Corporation, Exeter, World Financial, which is also Bread. They utilize VantageScore to tell the investor how the consumer is doing. And we're seeing the growth in that side of the business. So everyone out there finds that there is a level of predictiveness in our score. And the fact that we score more people means that there's more opportunity. Now, the one thing I will say is, yes, we score 33 million more people. That does not mean 33 million more Americans are credit worthy. They run the spectrum, you know, from that 300 to 850. And and 2/3 of them, to be quite frank, are below 620. So they're not going to be in that space. But the value is folks who didn't have a score now have one, right? In the past, they would have been beholden to the financial institution when you came in to say, hey, we have no credit score. We have to put you in the riskiest bucket, and we're charging you the most for the money you want to borrow. Now the consumer can sit back and say, you know what? Yeah, I'm subprime. Maybe I need to your point, improve, right? Do some of those things, make sure my credit report is right. They've got all the right information, make sure that I'm getting my rental payments put in there if I can find a way to do that, and improve so I can get better pricing. Or they can sit there and say, you know what, I really need this, so let me get the most accurate price that I can get. So again, the consumer benefits from having that opportunity to really take advantage of more robust and reflective pricing for them, as opposed to just being beholden to somebody saying you're the riskiest we've got and we're throwing you in the highest interest rate bucket.
Well, go ahead, Josh.
What I'm going to say is Tony, you had mentioned that things like streaming services, things that you guys can pick up and include in the score. Another piece, I actually just saw a video the other day about the explosive growth of buy now, pay later, which is not picked up in most of any credit scoring systems, and skews younger. Older people are catching on and using it more now also. Yep. Does that come into play at all with VantageScore?
So right now it does not. And the reason it does not is because, to your first point, it's not being captured by the credit reporting companies. But just like we're pushing to have the rental payments pulled in, we're pushing to get that buy now, pay later information in there. One, because it's going to give you a better understanding of the consumer's entire financial picture. Right now, I know a number of people will hear about a shadow credit market out there, and they're referring to that BNPL, buy now, pay later market because it doesn't show up. The key is it can be both beneficial, but it can also be detrimental, meaning that you'll add more debt onto your existing debt, and depending upon where you are in the payment, it'll change your utilization. However, if you're paying it off and you have paid it off, you're going to want some level of benefit for that. So we need to capture that. Unfortunately, there is no real comprehensive mechanism to capture that, but we're working with our the stakeholders, TransUnion, Experian, Equifax, other consumer advocate groups, folks out there to see if we can get that information captured. And just like you have in a Suzu on the rental side, you also have other aggregators on the buy now, pay later side who are trying to get all this information.
Got it. So when thinking about this and thinking about the consumer, is there something that the consumer needs to do now on their behalf so that when this comes into effect that they're already in that position and they're not having to backtrack and then start doing things in order to generate that model? And then I guess the second question that you can just kind of tie into that is my understanding of the old school FICO model is like when you make a payment, you make a credit card payment, whatever, they only report that to the bureaus, say maybe once a month, right? So the credit score is maybe lagging to some degree based on when payments were made. Is the VantageScore model any differently? Does it reflect today type of thing, or is it also a similar model in that it's only generating that score maybe once a month?
So our score can be generated ongoing. So as the information is put in there, it can be generated on an ongoing basis. That's the one great thing about having a lot of the automation put into the system, and it makes it fresh. It keeps the score fresh. But what can consumers do? Consumers need to do the same things that they were doing when they were preparing for home ownership before, right? Make sure that you're reducing or you've got your credit utilization under control. Don't go out there and make any crazy purchases before you purchase the house. One of the, it was funny. We were talking about underserved communities, immigrant communities, and folks who just didn't really know about the credit buying process. I'm in my second home. I've been in this one for 22 years. The first one I bought 2 years before that. So only 24 years ago, I was new to the process. And I came from a family where, my mom never owned a home. My dad didn't own a home. I mean, they lived in their parents' homes whom had bought, but that the information about buying was not, passed down to my generation. So I and my brother had to figure out how to do this. Complicating thing is my wife is an immigrant from Ireland. So she had no idea about buying housing in America. And, be quite frank, over in Ireland, that house that she grew up in, they've had in their family for 200 plus years. So it's not like they refinanced or had to come up with a mortgage. So we had to go out and find reputable counselors, realtors, mortgage brokers who had our best interests at heart and really taught us about the process. When we went in and said, hey, we're interested in purchasing a home, they sat down with us and actually had conversations about, well, how much are you looking to spend? How much are you spending for rent right now? What does your monthly debt to income look like? What does your debt to income look like? What does your monthly expenditure look like? How are you handling your payments? And when they found all that information out, they said, okay, this is what you need to do. You need to make sure you start reducing some of that credit so you can get a higher rate. And you can also free up more capital so that you can put toward the mortgage, because you're losing investment on a rental. You want to gain some return on that investment, equity, if you will, when you purchase a house. So all of the things that you tell these first-time home buyers to do, they need to continue to do. They have to, really understand, how am I going to save for that down payment? Am I going to put 3% down like I can do with a conventional conforming mortgage from Fannie Mae and Freddie Mac? Am I going to do 3.5 and go FHA and have to pay that the life of the loan? Am I going to do 20% down so I don't have any mortgage insurance, or am I going to do something less? They need to think about all of that and figure out, one, where is that down payment coming from? how am I going to make my monthly payment? How am I going to make my monthly payment along with the other expenses that come with housing, which, to be quite honest, I had no idea about. Utilities we all know about, but you got to mow the lawn, right? I didn't have to pay for water when I rented. Now you got to pay for water. And if I want to have a lawn that it needs to be mowed, I got to water it. That cost. And what happens if my windows get broke? What happens if I need to repair my roof? All of a sudden now all this other stuff. So having a really good understanding of what you can afford, knowing that up front, and I know you guys teach that, and I know you guys share that, that's the most valuable information that new folks to this process can have. Because what we find is there are a lot of people who get in the door, and we saw this, to the point we were making earlier during the Great Recession. There were people who got in the door, but it wasn't sustainable. And what we want to see right now, and this is what the conventional conforming market wants to see, and this is why Senator Tim Scott and Mark Warner put this credit score competition out, because they want to make sure that throughout the ecosystem and the mechanism of home ownership, that we're solving for sustainable home ownership. So credit scoring is just one small piece of it. It's the first evaluation of letting you, the consumer, and the financial institution know where you are in terms of being able to handle debt. And this being the most important, most significant amount of debt, you're going to want to know, and they're going to want to know.
On that topic of competition, I do want to bring this up. So part of the reason why FICO has a monopoly on this, they are the only company approved to provide these scores. And you say, okay, not a problem, because the cost of a FICO score is very minimal. Post-COVID, it's up about 800% what they charge. So to a consumer, when you're looking at thousands of dollars of closing costs, when an appraisal is $500 or $600 and a credit report's $110, you look at it and you go, it's nothing. Well, a few years ago, it was $30 to $40, and it is literally tripled in cost because we have given one provider the monopoly on doing this. So I don't know how much a duopoly is any better at that, because it's very easy for two competitors to say, let's not fight on price. And I'm sure that's not necessarily something you want to talk about, but this is critical and essential. We can't open this up to 1,000 providers. But where do you see this impacting the cost of credit scores? Because the actual cost of the credit score is a very small part of that, but there's multiple pieces in the chain and it gets marked up. And that $1 score goes to $3, goes to $8, and now you have a $100 credit report in the file.
Yeah, no, and credit score competition, one, you're right. There's one monopoly, and the biggest portion, the two parts of that, one is cost. The other piece is innovation, right? So if you don't have a competitor pushing you to be better, you're going to just continue to do the things that you do. And what we've seen is that old model, and we talked about this at the onset of the podcast, was built between 30 and 40 years ago and doesn't really reflect who the consumers are today. So because there is a lack of competition, there's a lack of innovation. So you lose all of that potential increases in tech and information that should be included that would benefit today's consumer. Now, once you solve for that and you have two or maybe three, I don't know what the magic number is for credit score competition out there is. And I would say that we welcome it, right? I'd like to have FICO come out and say they have a better product, or show that they do, so we improve ours and show that we can get better, and then we keep getting better for both the financial institutions and the consumers. And if there's a third organizational fourth that comes in and does the same thing, that's great. To your point, we can't have 100 of them. Like I said, I don't know what the magic number is, but I think that that's what you need to spur the innovation that we need to ensure that we reach that plateau of sustainable home ownership and we fully understand the consumers in the marketplace. Now, in terms of pricing, the one thing I can't do is talk to price, and the reason I can't, and I probably should have started this, and maybe as we edit, you can throw it to the top, but VantageScore is owned by the three credit reporting companies, TransUnion, Experian, Equifax. They built us, or they started us to be competition across all financial pillars against Fair Isaacs out there, because again, they were looking to make sure that there was competition in price. They've got to compete with each other, number one. So there's competition between the three of them, but then there's competition between the VantageScore and the Fair Isaacs score. And then just think about this. You've got competition between what each of them sells those scores for. Now, we have no insight into that. And that's partially because of antitrust. because we're owned by those three competitors. We don't want to accidentally share secrets from one of the others, and they don't want to share whatever information they have with our direct competitor, FICO. So we don't have any information. I don't have any pricing. I can't make comments on pricing. The only thing I can say is the more that we're out in the marketplace and can compete, the more you should have better pricing. There should be.
The
And to be quite,
situation we're
to be
in
quite frank,
with
yeah, I was
prices
gonna say,
tripling in a 3-year period only happens under a monopoly. So having
that's right.
at least one other option can only help.
And the other thing I'll say on top of that is you've got a regulator in FHFA's director, Bill Pulte, who has come out numerous times, and people can like him or dislike him, but he's come out numerous times, and he's shown that he's willing to kind of go down this path. He wants to see some level of competition to drive price abatement. That's the whole impetus for making sure that VantageScore is out in the marketplace now, because he wants to drive that. He wants to see that price come down. Go ahead. I apologize.
Yeah, no, it's all good. So with that said, when can we expect Fannie, Freddie to start actually utilizing the score? I think that's the big question for everybody that this could benefit.
So, we're kind of waiting on the same notification. All I can tell you is this: they are working hand over fist, extremely hard to get it done. So July 8th, you had Director Pulte come out, FHFA Director Pulte come out and say, we want this done with immediate effect. That kicked Fannie Mae and Freddie Mac into high gear, and they're working to ensure that they can get that done in relative short order. Now, they've said that. They've not given a date. I don't know when the date's going to be, but I can tell you that they are feverishly working to get this done. And full disclosure, I've worked for both enterprises. Spent 10 years at Fannie in the late 90s, early 2000s. Was with Freddie Mac right after conservatorship from 2013 up to 2023. So I know both of those groups very well. And I've spoken to a number of folks in both, and they are working feverishly to get this done because they want to fulfill the director's directive and meet his expectations. But they also want to come out and ensure that the marketplace has what it needs so that they can operate in a very safe and sound manner, and that we can provide a nice path of sustainable homeownership to credit-worthy consumers. So I apologize, I can't give a date, but I do know that they're feverishly working at it.
If there was one out there, it probably would have already been in the press. So we look,
me,
and
the moment
we didn't think you were going to break it here. Yeah,
yeah. Call us first and let us throw it
I
on
will call
the
you guys first. Yeah, the moment I get it, it's not going to be a secret that long. My mother used to say, there was a telegraph, telephone, teletony. So I'm not going to hide it. I'm not going to hide it.
Well, we are going to wait to hear for it. I think we covered the important stuff here of what the educated homebuyer needs to know. This is a change. It's coming. It's coming in the near future, whether that's 3 months from now or 6 months from now. We're going to have this. It's going to improve things, and hopefully starts with Fannie and Freddie. It works its way through to VA and FHA loans. A lot of our first time buyers are veterans, or they are using FHA financing. It's a little bit easier, a little bit more lenient on the way in for people on the lower end of the credit spectrum. So all of that, a very good positive. We love talking with you guys at Vantage. I was able to do an interview a couple of years ago when this was kind of in the works, so happy that we're getting a little closer to it. But just in wrapping it up, anything that you'd like to share with someone who wants to become a home buyer?
Yeah, so one, I'll tell you, the Veterans Administration can accept a package right now with a VantageScore, because you're right, they don't use the credit score for evaluation. So it's just a matter of the lenders having their LOS system updated enough to be able to ingest a VantageScore, but the Veterans Association can. If your bank is a member of one of these federal home loan banks, Chicago, Cincinnati, Dallas, New York, San Francisco, members of those banks can pledge mortgage collateral utilizing the VantageScore 4.0. So potentially, if any of those lenders or those banks hold in portfolio mortgages before they provide them, they can utilize a VantageScore 4.0 right now. So your consumer could go out and ask their bank, hey, can you utilize a VantageScore 4.0 for pledge collateral at one of those federal home loan banks for my mortgage? So there is a runway for people to utilize it now. The one thing I would say to folks is who aren't in the process just yet, it's coming. That's number one. It's going to be here soon, and I'm thinking that it's going to be before the end of 2025. So I wholly believe
That's
that
not
Fannie
far
Mae.
off.
That's
Yeah,
not far
yeah.
off, but I wholly believe Fannie Mae and Freddie Mac are going to do that because, like I said, they're working feverishly, and I know the expectations of the director. We're going to get some guidance here shortly. I'm sure, and maybe have a day one implementation coming out shortly thereafter. So I'm really looking forward to that. The other thing I would say is continue to get your credit taken care of so that when you're able to take advantage of this, either under the current regime or the new one, you can. Because for me, home ownership is it's one of the most important things I think that we can do in the country, right? It helps you drive wealth. It helps you get some family stability. It helps stabilize community. Realtors talk about it all the time. Mortgage brokers talk about it all the time. The government talks about it all the time. If you can do this, do it. And we want to make sure that you can get there. Make sure that your credit is okay. Go to your credit provider or a credit counselor or your realtor or your mortgage broker. Ask them to pull your credit score. Ask them to pull your VantageScore. They can do it. If they have a relationship with Zactus, Factual Data, Cotality, Black Knight Ice, any other number of CRAs out there, Equifax Mortgage Services, you can get a VantageScore 4.0 for mortgage right now, and you'll know where you are on that spectrum. So you can now see, what your pricing potentially could look like. So I would say continue to do the things you guys are telling them. Check out your credit score. If it needs improving, make sure all errors are removed. Go ahead and start making sure you keep your payments on time. And within, whenever you're able to put the application in, you'll be closer to purchasing that first home.
No, good stuff. If Josh, I think we might have found a new co-host. If you're not here, I might just call
Yeah,
Tony.
we'll just have you fill in. You
No, he's good.
do it for us.
No, Tony, honestly,
That'd be fun. Hey, I'll come back. anytime
great
you
great
guys want. It's
information.
fun.
Honestly,
Yeah.
the channel's all about education, all about providing guidance and just giving people information so they can make sound decisions. And honestly, great episode. Appreciate the information. It will put, Tony's contact information or anything he wants in the description of the video. I'm not sure you'll be able to reach out to him directly, but any questions, we'll get them answered. So just, leave them in the comments or reach out to us directly. But until next time, make sure you buy right, borrow smart, build wealth. Adios.
Amigos.